Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified, systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
Welcome back to Turtle Talk, Episode 7. It's Friday, the 26th of September, 2025, and I'm Rich Brennan, coming to you from Brisbane. With me, as always, is my fellow Aussie turtle, Adam Havriliv, calling in from beautiful Scotland Island in Sydney, and of course, the legend himself, Jerry Parker. Jerry, before we dive in, I've got to ask, how did you enjoy Europe?
Oh, we had a great time in France and Italy. Good food, good people, lots of nice people we ran into who are really still being nice to Americans. So that was a lot of fun. But it was, it's all good things must come to an end. My dogs and birds missed me, and I'm glad to be home again. I'm going back to the Hedge Nordic Roundtable in November again. So it's my second time in Sweden, and meeting up with Moritz again. And so pray for me when I get in front of all those powerful mainstream CTAs.
Yes. Best of luck. Yeah. And tell me, did you manage to keep the weight off with all of that beautiful Parisian food?
Well, not as much as I needed to, but I'm fasting now. So back to my fighting weight really soon.
Back to the treadmill?
Yes. Oh, gosh, yes.
Yes. And Jerry, you're calling in from Florida today?
I am. I'm in Tampa, Florida. Yep. Nice weather here.
All right, gents. Well, it's great to have you both here. And for today's pod, we're going to keep things tight and focused. No guests this time around, just the three of us digging into the big themes. We'll kick off with the battle of the trend following indexes, check out some standout markets and charts in what's moved the needle, and then get into turtle tidbits, where we cover fractals, expectancy, the cutback rule, loose pants, and even a Seeking Alpha article on high vol trend following. Plus, we've got some excellent audience questions in Shell Mail, which we'll go over. But let's start with the indexes. So, Adam, over to you.
Okay, thanks, Rich. Time for the battle of the trend following indexes. It's a monthly pulse check on how classic trend is performing. And over to the report on the AussieTurtles.com website. We had a nice little bump last month, and that is really, really nice to see. And notably, it's significantly higher than our fellow travelers, being those other indices that we like to benchmark ourselves to. So a nice return of 4.4% for August. And if we, have a look, I think we're traveling quite well for September as well, but obviously that will be finalized in the next couple of days and then reported on shortly. But we were talking last month about the recovery. And I know we were sort of hatching our eggs and all that, but we were discussing, was it a V, U, or a W? And obviously it was fingers crossed for investors and market participants for a V. And it looks like it is indeed shaping up as a nice V-shaped recovery. But interestingly, I think our recovery here on the Classic Trend Index is looking a lot nicer than the other indices, and we're going to dig in and have a think about why that is. But it is nice to see that recovery taking place, and then just visually here, I mean, you could just see the difference in the accumulated returns between the two different products. So the CAGR remains far apart from the other indices. And then not only are we sort of demonstrating that standalone compounding CAGR maximizing performance, but on a risk-adjusted basis, we're also showing a huge outperformance. And looking here at the MAR and the Sharp, I mean, we're running numbers that are more than double, even triple what the other indices are demonstrating over that analysis period. So it's all looking pretty good. What are your thoughts, Rich?
Yeah, so we're going to be talking about a few of the topics today which lead to the conclusion about how our process maximizes CAGR. So there's some good topics coming up which we'll be discussing. But as we can see here, when we look at the VAMI chart, we see that the Classic Trend Index had its high water mark in February 2025, while all the other trend following indexes had their high water mark in about April 2024. So we can see from this VAMI chart, when we look at the table of statistics, we can see that we're only 4.6% away from another high watermark. So the good thing about the Classic Trend Index is this lifting power and the quick recovery. So, you know, with another good month or a couple of months, we might be back at that high watermark again. But in these topics we'll be discussing today, we'll be going into the mechanics of why we have this fast recovery and how we address maximizing compound annual growth. So it's going to be a good one today. Jerry, any thoughts from you about this month's Battle of the Trend Indexes?
Well, it's good that it's still looking really good for the Classic, and it just continues to show the power of holding on to those outliers and letting the profits run and not trying to get out too quickly and manage the smoothness. So we're not going to have the smoothness. We're going to have some ups and downs and some volatility and maybe some even bigger givebacks, drawdowns from profitable trades, but the profitable trades themselves will be larger. So all of these good characteristics that we keep talking about are manifesting themselves in this excellent outperformance that we've had. So let's just knock on wood and hope we continue.
So yeah, great. Let's shift gears into the price action itself. Time for what's moved the needle. So over to you, Rich.
Great, Adam. So this is what's moved the needle, and this is where we look at standout markets and the price action driving momentum. So, Jerry, you've got the JGB chart, the Japanese bonds, the copper chart and the LME copper chart lined up for us. So why don't you kick it off? Can you go into each of these charts and let us know what your thoughts are?
Well, these I've been having a tendency to focus on charts sometimes that just teach a lesson, and I think the JGB is a really good example of choppy market that with the loose pants and with the long-term systems, sometimes the best you can do is just not lose too much money and do infrequent trading. And this last breakout of the JGB looks like January to the downside. It had a nice profit built up, and it gave it all back very quickly with a big spike. But I didn't get knocked out. So not only am I loose pants on my trailing exit, my breakout exit or moving average exit, but also on my stop loss. I don't have my stop loss set too tight and too close. I like to say I don't really take small losses. I take optimal losses. They're sort of small, but not too small. And so I don't get chopped around. So I think that this chart is a good example of sometimes the best you can do is just hang in there and not get out unless the system is really measuring whether am I really compelled to get out here. So we had a nice profit. It turns into a loss. We still don't get out. The market goes right back down. We're still in at the original ATR and the original sale price. And so I think this is another great example of what it's like sometimes in a really choppy market if you play your cards right and have a system that's not too loose pants. I know we're going to talk about loose pants later, but in this particular situation, the loose pants, not only does it help you stay in a long-term trend, not get bounced out, let the trade maximize into a big outlier. Sometimes it helps with choppy markets where you're just not doing a lot of trading and you're able to stay in there and make the best out of a not a great situation.
Yeah, if I look at that chart and I see if we made tighter pants here, we'd be in and out all the time. There'd be massive over trading for no edge. So yeah, I can totally see where you're coming from.
And the copper charts, I wanted to show the two copper charts because, believe it or not, I'm the king of diversification, right? But I just started trading LME copper. I've been trading New York copper, and I really wasn't thinking too much about it. I trade Brent crude and WTI crude and gold and silver and Swiss and Euro markets that are sort of correlated. But you're like, I mean, you can't get two markets can't become more correlated than LME copper and New York copper. But because of the tariff situation a few weeks ago, the New York copper had a much different sell-off, a violent sell-off, and the LME copper sort of stayed in there and instead remained, flat to long. So I was listening to a podcast, pretty sure it was Moritz, and he mentioned, or he got me thinking about this copper somehow. I forgot how it was. And then I just said, okay, I'm adding it back to my portfolio. And, we're trading two different coppers. And he came up with this great saying the other day. I was messaging with him. He goes, same, but different. So they are same, but they're different. And that's what we go for. Like, no one cares more about diversification than classic trend followers and, and trend followers in general. But for us, we don't really care that much about it. I trade more markets than almost anyone, but I don't care that much about correlation. And I'm looking for the outlier. I'm hunting the outliers. And so can I get an outlier in LME copper and not New York copper? Sure. Can I get an outlier in one crude and not the other crude? Yes, of course. So that's what we're kind of doing. We're saying, yeah, it is almost the same market 99% of the time, but sometimes we'll get this outlier and the charts do look different, and it is worth adding it into a portfolio. I mean, for me, it's 400 markets. So, even if it's an exact duplicate of New York copper, it's going to have almost no impact on me unless it's a big, huge outlier trade. And I trade London sugar and London coffee as well as New York versions as well. So, but oftentimes on podcasts and stuff, we do hear CTAs talking about diversification and not trading markets and trying to find markets that are not correlated with each other and find diversified markets. But I would like to do that as well, but I'm not going to give up on markets that could produce an outlier, even though they're very similar to some other market. And we've seen it happen many, many times. So it's going to happen again.
So, Adam, over to you. You've got charts for a number of charts you want to go through. Can you step through them with us?
Yeah, sure. So it's a bit of a metals special this month for me. And I know we spoke about platinum a couple of months ago, and I was getting pretty excited because it had a sort of 40% rally. And then the moment I talk about it, of course, we get a correction and it pulls back $150. And, am I going to get stopped out here and look like an idiot because I'd just been talking about platinum and how good it was going? And luckily, the pants were loose enough and the trade remains on. But since then, we've had a real explosion in the metals, and silver in particular sort of just crept up over 34, 35. And then I guess when we were overseas, Rich, and not really looking at the screen too much, it's just absolutely skyrocketed. And I can see here this morning it's opened over $45. And we're getting into uncharted territory here with silver, very close to that all-time high of circa $50. And, the way I look at that is less overhead resistance, the potential for, it's already an outlier, I guess, in some sense, but we've got a potential for it to move into that, real wild sort of territory, and good support across the commodities or the metals complex. So, gold, silver, platinum, they're all up 40 to 50% for the year. And we've got 10%, 17%, and 15% for the month. which is obviously a big contributor to classic trend index performance for this month, I would assume. Certainly for my fund, we're having a great month, and the metals are a really, really big part of it. And then moving off metals into cattle, I just wanted to highlight the 1 year chart there, which is sort of reflective of recent performance for us, and I guess Jerry would also have this contract on. But then zooming out to the 5 year chart, and you can just see there the thing's been absolutely a fantastic performer over 5 years. I don't think it's been like a cocoa-like contributor to performance, but certainly just contributing almost every year, delivering something to the program. And I was just really impressed by that 5 year chart.
No, they're wonderful charts, gents. And look, we're a bit spoilt for choice right at this moment for some of these massive trends we're riding. So it could be shaping up for a good end of year. I'm keeping my fingers crossed on that one. But look, that's it for the charts. So now let's move on to our next segment where we can deep dive into some of the great topics this month. So over to you, Adam.
Okay, so time for Turtle Tidbits, where we tackle the bigger themes. We've got some heavyweight topics today. So, Rich, you're leading us off with fractals. Do you want to discuss the topic and lead us through it, please?
So I've been putting pen to paper over the last couple of weeks with my favourite topic, which is complex adaptive systems and fractals. And I just wanted to bring this topic up to describe a different way of viewing the markets, as opposed to the traditional Gaussian way of viewing the markets, because in most traditional models where they're focusing on things such as variance at risk, standard deviation, or the levels of diversification, how much is enough, they tend to be speaking in Gaussian terms, where you find that with a greater sample size, with greater bets, things start converging towards a mean. But if the markets are fractal in nature, which I'll discuss shortly, you'll find that there's this property in fractal systems called scale invariance, which means that we never get this situation where we get a convergence to the mean. We might get a very slow degradation to the mean, but in some systems where they have these dominant heavy tails, you find that they actually never converge to the mean. Now, what that means is it totally therefore changes the rule book. When we look at these systems, any complex adaptive system which has a finite lower bound, in other words, a zero bound, but it has an open-ended possibility, and it's an open system, we find that inevitably these systems become complex adaptive systems where we get fractal development occurring within these systems. And this is for those systems that don't have a central coordinator. So there's nothing centrally coordinating all of the actions of the agents in the system. So in the systems such as natural systems, in our human bodies, in the universe itself, and in the financial markets, there is no centrally governing body that controls what all of the agents are doing. So you've got to look at things from a ground-up perspective, from this lower finite bound where the smallest agent interactions occur. And then as we progressively put in more and more agents, we find that there are structures that start evolving in that system which are fractal in nature. So to understand this, if you could imagine the most fundamental unit of a financial market is the tick. And that's where a buyer and a seller come together and they transact price, and a tick is generated from that activity. And what we find is that when we start getting more and more agents coming in and more ticks occurring, there is two phenomena being created. There's what we call positive feedback being created, where we get an amplification of price or an increasing direction of price, either up or down, or we get what we call negative feedback, which is a suppression of that movement back to, let's mean reversion, or when it's trying to bring things back to an equilibrium state. Now, what you find when you add more and more agents into the system, all with their different models, all directing price in different ways with their models, this is putting a force into the market, which is creating this positive and negative feedback cycle. And what we find is that with any complex adaptive system that has a finite lower bound and an open-ended upper bound, we find that there is not a perfect elimination between mean reversion and positive feedback. There's no perfect equilibrium created. What we find is that at the lowest level, we find that mean reversion tends to dominate. So as soon as price starts moving, high-frequency traders, liquidity providers, etc., start imposing forces to try and bring it back to equilibrium. But as we scale up in the fractal system, we find that the positive feedback creates structures or a bias in the price series, and that bias feeds on itself, and you get structures being built on structures being built on structures. So what you find when you actually look at the price formation in these financial markets, you'll notice that they have a fractal structure. So if I look at a 1 minute chart, for instance, it's very hard to discriminate between a 1 minute chart and a monthly chart. They look very similar, but they have a fractal structure. In other words, they have what we call a scale invariant structure. The structure persists at all scales. So what I mean there is that in a Gaussian system, when you start zooming into a Gaussian system, you find that the structure starts dissipating down to zero as you get sort of more magnified and more magnified as you zoom into the system. But this is different to a fractal system where you find structure at all scales, from the micro scale to the meso scale to the macro scale. And we can see that in our charts. When we look at the minute chart, we see a lot of mean reversion. We see some trends in that chart. But as we scale up, we find that the positive feedback of the trends that exist in that structure, they start actually amplifying themselves. And the way we understand this is that more and more participants start acting on that structure as you scale up. So at the lowest level, you might get high-frequency traders, intraday traders. But as you scale up in the system, you start seeing trend followers coming in. You start seeing institutions coming in. You start seeing larger players coming in who are acting on the structure, which is this fractal structure, which is amplifying the structure. And no matter what complex adaptive system we look at, we see this occurring. And a good example is when we look at the formation of a human being from a zygote, which has no differentiated structure, to a human being itself, who has differentiated structure, we see that this is a complex adaptive system following these fractal rules. And at all scales, we start seeing the fine scale structure being amplified into organs, arms, feet, head, etc. We find that structure starts dominating as you scale up. The same as when we look at the universe, which, they anticipate started from a big bang, and there were very small deviations, quantum deviations, which created the structural filaments upon which amplification occurred to, as we scale up, create galaxies, planets, stars, all of these things. This positive feedback is creating this structural fabric which amplifies itself. And no matter how much mean reversion or noise we get in the system, we find that as we scale up these structures, the mean reversion and noise starts dissipating because they cancel each other out. They're not amplifying. But we find that positive structure starts compounding. This is this multiplicative process in the structural formation of a complex adaptive system. And we find that the positive feedback amplifies itself, trends get bigger. So if we imagine these financial markets where we have this fractal structure, you'll recognize that it doesn't matter how big in scale we go, there is always larger fractal structure ahead because of this positive feedback and amplification, which means that when we look at things such as diversification, the Gaussian assumption is, as you add more bets, things start smoothing towards an average or a median. But we find in these complex adaptive systems, the larger scale we get, the more chance we have of actually aligning our systems with the dominant fractal structures of that system. So if you can imagine, if I've got a tree is an example of a fractal system. A tree which has a large trunk, many branches, many leaves, many smaller twigs. If I put a very small sample over that tree, it is highly likely that I'm only going to get a few leaves, a few small twigs, but you'll find that the relationship in that sample has this fractal structure, and you'll find that relative to the sample you're taking, you'll still get some dominant contributors and small scale contributors. So you might get some leaves, some larger twigs in that small sample. They will, the scale invariant nature of fractal systems means that there will be outliers in that sample, maybe 5 to 10% in that sample. But as you scale up and you get bigger and bigger and bigger, and you start increasing, you encompass the entire tree, you get access to some of the bigger fractal structures, such as the trunks, the major branches. These are the things that are dominating financial returns. And this is why in complex adaptive systems, we get this Pareto principle, the 80-20 rule you might have heard about. This is because there are power laws in this fractal system, and this means that we find that there's a small percentage, because it's scale invariant, no matter what scale we go into, there is a consistent small percentage, 5 to 10%, which is dominating the overall returns of that sample. And that's because of the scale invariant fractal-based structure of the system. So I just wanted to bring that to the attention, because when you start looking at things from complex adaptive systems and you start seeing that the major dominant drivers of what moves price is the interactions that occur between buyers and sellers, you can reduce things to a mechanistic explanation, and you can start seeing when you add more and more agents together and we start getting these forces being exerted, or these impacts being exerted, some cancelling out, some amplifying themselves, you can see that as you scale up with this structural mechanistic interpretation, you start getting dominant structures starting to dominate the overall performance. And that's why if I look at a 1 minute chart and I compare it to a monthly chart, when I look at a monthly chart, I see these major trends in the monthly chart. Now, this is what most participants in that much larger scale have been trading towards. They're being focused on these long-term trends, the major causative drivers of trends, which we interpret as things such as macro and fundamental reasons for why these major price moves occur. But when you look at it from the fractal structure of these complex adaptive systems, you start seeing, this outcome is actually because of this positive feedback reinforcement that occurs. And as you scale up, the positive feedback starts dominating the mean reversion and noise. And this also explains why trend followers do far better in the medium to long-term space than in the short-term space, because in the short-term space, the fractal structure is dominated by mean reversion. But when you start scaling up, you start getting access to these major branches in the fractal system, which is really dominating returns. This is where the positive feedback concentrates and dominates in this autocorrelation or serial correlation we see. So,
look, fascinating stuff. You've written quite a detailed blog post on atstrading-solutions.com, the fractal feedback asymmetry of markets. I recommend that anybody who is interested have a look at that article. And I think the summary is basically that the negative feedback is fragile, but the positive feedback system is exponential wealth creation. And I think that as trend followers, we certainly want to be in the latter, compounding and exponential wealth creation mode, rather than the fragile mean reversion mode that some traders are still stuck in. Let's move on to the next topic, expectancy versus path dependence. What really matters? Now, Rich, do you want to compare expectancy against path dependence?
Yes, I do, Adam, and this is another post, and this is a lead on from the fractal nature of markets, and it's a function of dealing with complex adaptive systems. And what we find is that when we start looking through this different lens, fractals, complex adaptive systems, we see that the typical statistics that we've used to assess performance measures are invalid. A good example, as we all know, sharp world thinking that type of thinking is inappropriate for a fractal system or a complex adaptive system. We see that Gaussian assumptions of how frequently anomalies should occur are much less frequent. You know, one in every 13,000 years of a 5 sigma event, but we've seen about 30 or 40 of them in the last 100 years, greater than 5 sigma events. So we know markets are doing something that's non-Gaussian. We know that they have these fat-tailed properties. And this changes the entire ball game in looking in terms of statistics versus what I call engineering. I would say that trend followers are more concerned with an engineering solution than a statistical solution, because when you look at the statistical properties of markets, there are so many assumptions built into those statistics, and often they're incorrect. And a good example is the expectancy equation. So our listeners would be aware of the expectancy equation, and most traders are taught, provided they have positive expectancy, that's all they need to do to have a winning system. Now, that is fine in a particular class of systems that we're not dealing with in the financial markets. And those systems are called ergodic systems. However, the reality is these financial markets are non-ergodic systems. So think of it this way. In an ergodic system, the average across possibilities is the same as the average over time. So if we flip a fair coin forever, and your long-run results will converge to 50-50, the path you take to get there does not matter. And this is how the expectancy equation works. But in a non-ergodic system, the path changes everything. When you compound returns like we do in the markets, the sequence of wins and losses can permanently alter your trajectory. You can get wiped out before the average ever shows up. So wealth paths in markets are non-ergodic, and that's why expectancy on paper can look positive, yet in reality, compounding and absorbing barriers drag results towards zero unless your process is engineered to survive. So we know markets are non-Gaussian. They have fat-tailed properties, which means the traditional statistical tools we were taught to use often leave us wanting. So take the expectancy equation, which we'll put up on the screen. Traders are told it's the holy grail. If you have positive expectancy, you have an edge that leads to wealth. At least that is the promise of the equation. But in a world of fractals and complex adaptive systems, where we have a finite lower bound and an unbounded upside, expectancy has serious shortcomings. So look closely at that expectancy formula and notice what is missing. There is no reference in that formula to the sequence of returns. It assumes the world is ergodic, that the average works out over infinite time, but no absorbing limits exist in it. And we'll talk about what those absorbing limits are. But in real markets which are non-ergodic, the path matters and the sequence matters. And it's not just expectancy. The same issue undermines the classic risk of ruin equation, which I'll also put up on the screen. That is often touted as a universal truth. So both ignore the path dependency of compounding wealth. So I'm going to run a simple experiment and show you the outcomes. And this experiment is going to start with $100, where you flip a coin. Heads, you win 60%. Your capital grows therefore from $100 to $160. Tails, you lose 50%. Your capital falls to $50. Now, on paper, expectancy looks great, a positive 5% edge. But now, if I run many wealth paths over time, and I'll do this by hitting F9, and we'll see it updating over the course of time. Each time I hit F9, I'm running a new sequence of events. But you'll notice that every single wealth path decays to zero over time. Not one compounds to wealth. Why? Because there are two destructive forces that are always at play in path-dependent systems. The first is this absorbing barrier. So if a sequence of losses drives your capital to zero, you are out of the game. No money left, no future compounding. That barrier is fatal. And the second is compounding drag. When returns are applied conditionally to a non-ergodic path, losses bite harder than wins lift. From 100, for example, up to 160 on a win, then down to $80 on a loss. Keep flipping, and the negative compounding pressure pushes your trajectory towards zero. And we can see that in these examples as I'm hitting F9. So despite this positive expectancy, the wealth path is compromised. Statistics tell you that you have an edge, but the lived wealth path actually says otherwise. This is why survival, not just statistics, is paramount. And the trader's job is not to trust expectancy, but to engineer a process that can withstand asymmetry and sequence risk. That's why I say a trend follower is more of an engineer than a statistician. So we design systems with small bets, wide diversification and rules that cut losses and let winners run. And this process generates enough lifting power to dwarf the ever-present drag of non-ergodicity. So expectancy may look like the holy grail, but in practice it is mute on the one thing that really matters, the path. And in trading, the path is everything. So now let's flip the problem around. Instead of letting chance dictate our path, what happens when we engineer the outcome with a positively skewed process? So a classic trend follower does not need to win often. In fact, the typical profile is only about, say, 30% wins and 70% losses. On paper, that sounds terrible, but here's the key. The winners are, on average, 3 times larger than the losers, and this builds in the necessary asymmetry to change the wealth path. So how do we make that work in practice? So in this example I'm giving now, by cutting leverage right down, in other words, by placing very small bets that are as small as possible, that takes a sting out of the inevitable string of losses. Small bets make losing survivable. Then when the big winner does show up, that positive skew takes over and the asymmetry flips the math in our favour. So now, instead of compounding dragging us down towards ruin, compounding accelerates the wealth path upward. And this is the difference between statistics and engineering. The statistical mindset says if expectancy is positive, you have an edge. But the engineered mindset says structure the process so that the edge actually survives in the real world. So by deliberately embracing small bets and positive skew, with our massively diversified portfolios that hunt for outliers, we turn these wealth paths from fragile into resilient wealth paths, and we transform compounding from a drag into a tailwind. And that is what engineered trading looks like. You need extra asymmetry to lift yourself. And so when you look at the rules of a trend follower, what are they? One is small bet size. Why small bet size? Well, what you find in this equation of path dependence is that the higher volatility you have, the greater the impact on this degradation of returns through compounding drag. The relationship between small bet size and the volatility drag is one of the fundamental engineering reasons to maintain this path-dependent return. Another thing, why do we maximize as wide as possible? We maximize as wide as possible to get these fractal branches that exist in this system. We don't know where these outliers exist, but if markets are fractal and they've got these major dominant branches driving compounding, our nets need to encompass the entire system to be able to drive up that positive asymmetry to exceed that expectancy problem with the compounding drag. All of our rules are based around engineering. It's not based on statistics, because the statistics leads us astray. It's about how do we achieve a path of returns that survives long enough to compound. And as we'll get into more of these topics, you'll see that the principle of survival comes at the forefront of everything we do. It's not about statistics. It's not about maths. It's not about being a quant. It's about engineering a survival path. We do that with small bet sizes. We do that with stop losses. We do that, as Jerry will get onto, with the cutback rule. All of these are engineering responses to ensure that we've got a path of survival which maximizes compound annual growth rate, the geometrical returns in a non-ergodic system.
Right. I think so. I think it's good for you to make sure you're always separating. Because until the very end, I thought that my equity was eventually going to zero. But you sort of eventually said, if you're riding these outliers and you're taking small losses and diversifying, and you're having to say symmetry, then this is how you overcome all these bad things. And I didn't understand. I probably don't understand exactly what you mean by expectancy and how asymmetry overcomes expectancy. So, because when we run our back test, we all have an expectation per trade. It is just a number, and if it's a high number, that's good. And so, I want my my expectation per trade to be high. But so that's the issue I had, which I was wondering, like, what's wrong with that? And of course, if you're having issues with drawdowns or whatever, you could do the cutback rule, or you can keep following your system and hunt these outliers. But I think we all think having a high expectation per trade is a good thing. And I didn't really understand what you meant by it. You obviously didn't mean that.
There is no problem having a high expectancy, but the expectancy must exceed the negative asymmetry that the wealth path is creating.
Yeah, and that's counterintuitive because 60% is higher than 50%, but
yes.
You're saying that because of the compounding effect, the 60 is not enough relative to the 50.
Yes.
So you've got to have some ratio between the winning not the winning percentage, but the winning amount.
That's
and
right.
The losing amount that can overcome the negative of the loss.
And path dependence is the only way to overcome that. And what I mean by path dependence, you have got to manage that path to prevent the negative drag or that absorbing barrier I talked about taking you out of the game.
Okay, and then how do trend followers intuitively know this and do this without knowing about non-ergodic systems?
Okay, so classic trend followers do it naturally with their process. Now, what I'm arguing is that other trend followers aren't doing it. Now, what I'm saying is that classic trend followers, they ensure that their outliers are not clipped. Imagine if you start reducing the volatility of your upside, the beneficial upside, you are naturally going to change your wealth path to a non-ergodic declining wealth path over the long term. If you have a smooth return stream that doesn't harness the power of outliers to lift yourself out of this negative compounded geometry, you're going to find that over the long term you are more exposed and more fragile. A classic trend follower, because when you start putting this growth path into a positively skewed system, you find that suddenly how we talk about the two-edged sword of compounding? There can be beneficial compounding, there can be adverse compounding. We often talk about the two-edged sword of compounding. If you are losing money and compounding takes hold, you start exponentially losing money. If you are making money and compounding takes hold, you start exponentially making money. There is this sweet spot, which is not the expectancy equation. It's the asymmetry, the geometric path that needs to be exceeded to have this beneficial compounding. And I'm saying classic trend followers with their process naturally fall on this path that exceeds all of the negative outcomes, the absorbing barrier and the negative drag of compounding through their process, because we are adopting positive skew, we're maximizing outliers, we're giving every opportunity for the step-ups, the outliers, to massively overcompensate for these negative drag effects associated with it.
Yeah, so
with the typical classic trend follower system, have a higher average trade than the managed futures CTA.
Yes, they will.
So we like our expectation per trade because it incorporates the outliers and the asymmetry. And so if everyone traded like us, we wouldn't be complaining about the expectation per trade because it would be much higher.
Yes, Jerry.
Right.
And so what we find is that because we've got a high average trade win against losses, that more than compensates for the effect of those losses. We also find that our small bet size more than compensates for the asymmetry in the geometry of returns. Our diversification more than compensates because we are massively diversifying to achieve these significant compounded events or these massive outliers that drive our returns. Everything we do is actually an engineered outcome without maybe us realizing it statistically. It's to achieve maximum compound annual growth rate.
And when Mike Schell and other people talk about how harmful drawdowns are to compounding, they're missing the fact that drawdowns from a classic trend point of view, they're not as harmful because they're overwhelmed by the uplifting.
Exactly. And if we can imagine a scenario, Jerry, where we have this change in the trend following model where we've started seeing smoother returns being generated, people are volatility targeting, people are dynamic position sizing. What that is doing is compromising the uplifting power which is necessary to overcome this asymmetry. And this is why my thoughts are, why do classic trend followers snap back very quickly from a drawdown? It's because of this beneficial asymmetry. Why do the others take longer to recover from this drawdown? It's because of this natural drag in the compounding equation.
Well, I think that naturally leads us to the third topic, that being why the cutback rule is essential for survival. And we know that Jerry has some strong views on this topic. Can you once again describe the cutback rule? What is its role in survival? Please lead us through it, Jerry.
Okay, so I think the cutback rule is a very important rule, and it's the ultimate rule, and that is when you're losing money, maybe you define what that means to you. If you're down 10%, 20%, 30%, however you want to set up your fund and have a certain risk profile, then you're going to reduce. Cutback rule says, okay, when I hit these drawdown levels, I'm going to reduce my current positions and my future trades faster than I'm losing money. So with the turtles, we traded very short term and we traded with very high leverage. So I do think that there's a different answer if you trade long term with low to moderate leverage. But for the example, though, the turtles would, if they were down 10%, just a 10% drawdown, they would cut back the current positions by 20%, so twice as fast as your losses. And then the future trades for the foreseeable future until you make this money back would be cut back at 20% as well. So if you're down 20%, you're going to make the 40% cut back. So it's a non-system trade. It's strictly there to help you stay in the game and allow you to continue following the system. I think this is one of the most amazing things about it. And this philosophy is, what do I do? Well, I'm really destabilized. I'm losing money. This is not part of the back test. What do I do? Well, the most important thing for you to do is continue to take the same trades in the same way, the exact same trades, and not skip trades and use discretion. Because you're going to not come out of this drawdown if you're skipping trades and having to choose which trades to do. So the cutback rule says, nope, just reduce your trading size at least, or maybe even faster or greater than the loss, and go right back to following these systems. So I think that is but like I said, it is a non-system trade. It is undoubtedly going to make ensure that you're going to make less money. You would be much better off trading smaller and not ever having or rarely having to use this cutback rule. And I think now, with my leverage and my the leverage that we use and the long-term nature of our systems, we're seldom getting into a situation where we're going to have to use the cutback rule.
So, Jerry, if you rewind back to the 80s when you were trading with Richard Dennis and William Eckhart, how often were you invoking the cutback rule yourself or the other traders that you were trading with?
Frequently. we were trading way too large, and it was almost like this game. In an outlier trade, it would be much smaller than an outlier trade now. So like an outlier trade for me might be 50 to 100 ATR. Back then it was 20. That was the magic number. 20 ATRs, that's a really big outlier trade. So it's a whole different game when you're using massive leverage, making 200% a year, trading very short term. But if you remember this guy, Jez Liberty, he ran a website and he took some turtle systems and he figured that if the turtles just traded a little bit smaller and tried to make 100% or 150% rather than 200%, and the cutback rule would have been used a lot less, and they actually would have made more money. I have no doubt that that's probably true. I have no doubt about it.
Would it be correct to say that the trading has, quote unquote, slowed down in terms of you're using wider parameters and there is less overall trading now in the program, your program, than there was back in the 80s?
Yes, there's much longer term and much lower leverage, so much better diversification. And I really focus a lot on protecting the closed trade equity, the capital in the account, the P&L, the realized profits and losses, plus the investments. And it's seldom happens that the drawdown in the closed trade equity is not exceeded by the open trade equity. So to some degree, CPAs never have drawdowns. If you're looking at your capital account, the original money that the client gave you, and including the realized trades, that drawdown never is exceeded. The drawdown is never greater than the open trade equities. And you could, after a startup period, you could liquidate the account on any day and recover your entire closed trade equity drawdown with the open trade profits. So to some degree, I think that can change. That probably is going to change one of these days where we're going to see that happen. I don't think it really is fatal, but to some degree, I think if you use closed trade equity as your trade level and you sort of have the mindset of protecting that and then allowing yourself the freedom to not care so much about open trades in the sense that you're going to override the system. You develop these systems based upon the back test, what makes the most amount of money, and you want to carry those rules forward and carry them out. So you can do that, and the best way to do that is to not put yourself in a situation where you're even thinking or looking at a drawdown of profitable trades.
Rich, what are your thoughts, Rich?
I view this as an engineering solution again to ensure that you survive. In other words, it's all about the path of returns. And what I'm saying is that when we do our back testing and our model development, we inevitably have our first line of defense. Small bets, stop losses, trailing stops, massive diversification. That's what our models give us. But then we might enter an environment we have never experienced in the past, which can actually start compromising our core equity, what I call the closed realized balance. So in that instance, you need to intercede with the discretionary rule, because this is a regime that has never occurred in your backtest. We recognize that the future is unbounded. There are so many different possible paths, and what we've experienced in our backtest to get us our front line of defense, that's been integrated into the model. But now we've got this environment where we're finding that our closed trade equity, the thing that we've got to protect at all costs to survive the absorbing barrier, to a survive, compounding drag, that's being compromised. So we need to intercede with the discretionary rule to massively cut back our exposure to at least survive until we're out of that regime. So, for instance, I'd have a rule where a cutback rule would be applied as soon as my closed balanced equity was being threatened, and it would only be turned back on or once I achieved a high watermark. So I'd massively reduce my position sizing faster than what the drawdowns were occurring to just defend myself and protect myself, and wait until the regime is passed and I'm actually back up to my high watermark where I am, and then I'd revert back to my original position sizing. So it's the last line of defence as far as I'm concerned, and it's a necessary discretionary rule to override when a system encounters a regime that's never been experienced in their backtest.
It's not necessarily discretionary in the sense that you have the rule, and you're going to when you're going to use it, and you're going to know when you're going to go back to trading the full speed. It's more like it's no sample size, and thankfully, the sample size is 0 in the back test. That's fantastic, and we basically are trying to do legitimate, robust research, come up with these systems that have have a large sample size, and we have these great systems that are going to maximize CAGR, and but they're going to hunt these outliers and maximize the profit on these outliers, and we give that an A+ with our systems. And we still say we got to have the cutback rule in case we see a future that looks really bad. And so that's genius. You're kidding. Why do you have to worry about this? You came up with these monsterly, most profitable systems. They're fantastic. And you're still going to have a cutback rule. Yeah, because we're humble and we're afraid of the future and we're risk managers. We have to stay in the game, and bad things can happen even though we're trading the best systems possible. And you're still going to not rely upon that back test to say, we've never seen it, so we don't have to worry about it. Or if we do see it, then we know the systems no longer work. That's another thing that people say that's kind of silly. You've never seen something in the back test, and if you see it, if it's bad enough, you can just shut the systems down. As someone told me that a famous trader did that, and a week after doing that, months after shutting his systems down, he figured out that it was making new highs. So yeah, I think every single time I've used the cutback rule, it was at the bottom. That's just going to happen. It was at the bottom of the drawdown, and I made the cutback. But you only have to be wrong one time, so you need to keep preserving that capital, do whatever you need to do that, and suffer worse performance and use a rule that doesn't have sample size in order to stay in the game.
Yeah, that's what it's all about. That risk of ruin and minimizing the chance that you can't keep trading tomorrow is super, super important. So we're looking at path dependence. We've worked out that we need to take small bets on individual trades. And I guess by extension, we would also say that if we're taking lots of trades, the aggregate of all those trades should not be a large amount, such that it threatens the viability of the account. So if we are taking these really, really small bets and lots of them, loose pants, I think, is the next topic. How do we use loose pants to effectively leverage a system that's only taking really, really small bets? Jerry, could you please explain loose pants to us?
Well, I wanted to make sure I knew what loose pants meant, so I asked ChatGPT, and it told me. And I no surprise, wide stop losses. I don't like the word stop losses. Wide trailing stops, and not being too eager to get out of the trade, and optimal stop losses. That's the way I look at it. I have an optimal, perfect place to get out of the trade, not too fast, not too slow. And you're just doing less frequent trading, and you're willing to tolerate drawdowns. And we do all of these things because the computer told us to. Like, I would not do it. I only do things that the computer says is something I should do, and it's the best thing I can possibly do. So I think sometimes the words fail us. I like loose pants. I like classic trend. I like trend following. I like all these words we use, but it's really very deep in the Python somewhere. And that's all I care about, and that's all I do. And anything short of the actual code and the rules is inferior. But I do think loose pants gives a great philosophy of, don't look at the chart with your human eyes and say, it looks like the trend has ended, or it looks like the trends should continue. These are just all subjective things. Just pay attention to the numbers. And the numbers in the backtest says you can't be as long-term as you should be. You're a human. Try to have as loose pants as possible. But it's really difficult to do psychologically. I think people look at the numbers and look at what the computer tells them, and they're like, no, I'm not going to choose that, or I'm going to throw in sharp. Yeah, that's the real bullshit idea there too, is that I'm going to throw in sharp, because that'll help me take profits on the way up, and that'll help me smooth things out. And everybody looks at sharp. And so I think that's how people convince themselves that don't maximize these outlier trends, don't maximize Kager, don't have loose pants because they want to live in the sharp world. The sharp world helps them sleep at night. Sleeping at night is overrated. Making money is a lot more important.
Yeah, I think people would probably be surprised at how small the position sizes are relative to the size of our respective funds, and then how wide the stops are, right? So I think when people think about trading, they think about, buying 10, 20, 50, 100 lots of some contract and then eking out a few points here or there. And, I think that's called scalping, something that we would obviously never advocate as classic trend followers. But we're almost the opposite. We're looking to trade very, very few contracts, which represent a very, very small proportion of the fund, but have these optimal stops, as you described, Jerry, chosen by the backtest, not necessarily the chart. I mean, we love to look at these charts every month because we're living and breathing that P&L, and it's exciting. It's exciting to watch these markets move, but it's not necessarily that helpful when it comes to classical trend following, right?
Yeah, I've heard traders recently even say that they have altered their systems because they're trend followers, and their system was keeping them in a trade when it looks like, with the human eye, that the trend had sort of ended. And I think that's just nonsense. It doesn't matter what your eye says. It doesn't matter if you don't, it's okay if you don't call what you do trend following. I think our highest loyalty should be to systematic trading, and that's what we should be faithful to, is following the rules, following the systems. And for us, it is going to be trend following, and it is a pretty decent way of describing it. But sometimes I've even had people sit down with me, clients, and show me a chart and say, you didn't get out of this trend here on the chart. And everyone knows that that's when the trend ended. And so you have to listen to a lot of nonsense, and people who don't know too much about trading. You have to listen to clients like that. But we should, we are what we are. We do what we do strictly. If you, like me, if you follow what the computer says. And I was talking to a famous trader one time, and I asked him about his stop loss, and I was like, don't you think the stops that you use are just too tight, and they just create a lot of whipsaws? And he goes, yeah, but that's just my personality. I've never said that in my entire life.
Yeah, because you're relying on a backtest, which are facts and figures and statistics. Yeah. And as you say, optimal, as opposed to a subjective view of a chart, depending on how you feel, or you slept the night before, or whether you're jet lagged or whatever. But I think relying on the backtest.
Yeah, but I think my point is a tad different from that, and that is I'm choosing whatever the computer says. The computer says it, then I'm going to do it. And I think that's rare. People say, no, go back to the drawing board. Don't choose that. because that's too difficult.
Now, leading us to the last topic here, topic 5, high vol trend following, right? The most valuable alternative investment. And there is a Seeking Alpha article, Jerry, that you have found and shared with us. I've had a quick read. Could you please take us through the key takeaways?
Well, I think the key takeaway here is that it really is helpful for portfolios to include trend following, diversified CTA trend following, and don't shy away from CTAs who have used higher leverage, because your investment can be less in dollar terms and get more bang for your buck, essentially. And of course, that's true. I think that's a difficult thing to pull off. At one point he says a 15% allocation to a high vol strategy targeting 40 to 80% returns. I mean, who are these people who are targeting 40 to 80%? Because the drawdowns would be pretty hellacious. And 80%, you'd have to figure out a way to use the cutback rule frequently if you're shooting for those kind of returns. But I do think that institutions over the years, they say, have encouraged CTAs to trade smaller and to use non-classic methods to smooth out the returns. And the article is kind of saying, yeah, but you need CTAs, you need them in style and big doses, and it's more efficient to allocate, to CTAs who are not trying to make 5 or 10% a year, but maybe a lot more than that. And he does sort of take a shot at our favorite CTA groups that reduce the positions when volatility heats up. And I talked to the author today, and I said, oh yeah, remember that time where the CTAs were short the stocks in 2008, and they're making so much money and the ball was picking up. At the exact time their clients needed that short stock exposure, they were buying the shorts back to smooth out the returns. So I think you don't have to look very far to be very thankful that you don't do things like that, and we're all sticking to the classic way.
Yes. I know that some of these funds actually do offer, multiple leverage options. So you might be able to go with a low volatility option or a high volatility option. And so sometimes that allows investors to make an allocation based on their preference. But yes, I think the principle that, choosing a fund with a higher vol allows you to allocate a smaller amount, probably makes sense. What are your thoughts, Rich?
My only concern is that I talked about the two-edged sort of compounding. Now, high vol and positive skew is a beautiful marriage in heaven. That actually amplifies returns. But no skew and high vol absolutely sacrifices returns. So only in those instances where we have positive skew can we apply this high vol principle. So I'd be saying,
right,
classic trend is a perfect accompaniment to really move the needle as an allocation into a traditional portfolio, because it naturally encompasses what I call a beneficial volatility. So the article that I read, which Jerry referred me to, obviously criticises Sharp and these traditional metrics. It talks about how they prefer to use Sortino. I'd say, well, actually, Sortino is not a path-dependent metric itself, so I actually don't even like Sortino. I much prefer the compounded geometry, geometrical paths, as a way to describe the best outcome, because you need to look at, is the volatility beneficial or is it adverse? And under high volatility, one is crippling and one is magnifies your compounding. So in our case of classic trend following, we're fortunately in the positive skew side with high vol that just amplifies our returns further. That's generally my thoughts.
Just in general, I think looking at volatility is mostly going to be incorrect. There's a couple of bullet points in the article. One is all volatility isn't bad volatility. I don't think any volatility is necessarily bad. If it's a winning trade, if you're going to get out with a small loss, I don't care how volatile it is, that never was a problem. You have your small bet, you took your small loss with your small bet. I don't think there is any sort of volatility that's a problem with a winning trade. I mean, look, it's not so much volatility that we hate. It's we had a big profit, now it's a small profit. If it happens over a month or two, or it happens over a day or two, I'm really not happy in either scenario. So I don't really see another bullet point is volatility isn't risk when it's working for you. I don't think it's ever risk, and I think you're looking at downside volatility and upside volatility, you're getting more information. I think I wouldn't get rid of upside volatility as a risk measurement, because it's probably going to be a good indication of what the possible downside volatility could be, and your sample size will be increased. But I just don't think you should even care about it too much. Protect that capital, protect that closed trade equity, and let those profits run and follow your system. That's really what you need to do. If you want those wonderful returns that you saw in the back test, the computer's asking you one thing. Do you want these? Yes, I do. They are awesome. Yes, they are. All you have to do is do the same, follow the same rules that I followed historically, follow them in the future. But what about? Shut up about what about. Profits going to turn into losses. It's going to happen. You're going to have drawdowns primarily with your open trades. And so I think CTA is wading into this and trying to find a narrow path to like volatility sometimes and dislike it. I think just forget that. It's not. Their trend following has some magic to it, and you're destroying the magic when you destroy the outliers and don't follow your rules.
Well, I think that's a good way to close this segment of Turtle Tidbits. Now, over to Rich for Shell Mail.
All right, thanks, Adam. So we'll open the Shell Mail inbox, and we've got some excellent questions this month. So firstly, a question from Dan, who from X. So Dan says, what do you think about sizing things larger that are better diversifiers, or where we have fewer of them, like commodities, versus smaller sizing for something we have 30 of, like indices? So that's his question. So over to you, Jerry, first, and then Adam.
This is a good question. I think, I think that the first step for every trader, the first step for me anyways, is to put together this portfolio. And I'm going to create my portfolio. It's going to be a fixed portfolio. I might take some things out for liquidity reasons in the future and add things in the future, because as more markets come on, and I can further reduce my bet size. But overall, I'm going to put together this portfolio, and I trade single stocks. And so I could have a portfolio that had thousands or hundreds of single stocks and would overwhelm all of the other diversifying markets. So I think you need to put a break on, and put your portfolio together with that in mind, that you do want some diversification, maybe 25% each sector or something like that. But I would be hesitant to use a different bet size or unit size for commodities, for instance, because they have more diversification. And because like I said earlier, we like diversification. We have more of it than most everybody else in the hedge fund world. But we're really trying to hunt outliers. And as we said earlier, if things are correlated, it doesn't mean one of the two highly correlated markets might have an outlier that the other ones don't have.
You did, Jerry.
So I think following on from what Jerry said, yes, so we break our contracts, we allocate them to 4 asset classes, being equity indices, bonds or interest rates, and commodities and foreign exchange. So I think it would be a reasonable approach to limit each asset class to 25% of the aggregate risk if you wanted to. But I think, Jerry, you're correct. Well, you're definitely correct. The commodities do have unique properties, and those commodities, in our opinion, have a lower internal correlation than, let's say, related indices or interest rates or FX when you're trading a lot of dollar pairs. right? So an example, euro to the US dollar or the Swiss franc to the US dollar, that is just going to have a higher correlation than, let's say, gold and orange juice. So in our opinion, a larger allocation to commodities does make sense. But I could also see the argument, if you're trading 2 units of energy that are very, very similar but not identical, so Brent crude and WTI crude, you could make an argument to split that risk in half. We don't actually do that, so we do allocate a unit of risk each to each of those contracts. But I think that's just something to work with in the back test, put it in the computer and see where it leads.
We'll move on to the next question. This is from Matthew Young from Houston, Texas. And Matthew says, I'm worried about another lost decade like 2008 to 2018 for trend following. Can you comment on what contributed to that and whether the picture looks different now? So that's a great question from Matthew. And look, I'll throw it first to you, Adam, and then to Jerry. So, Adam, your thoughts?
So the lost decade in trend following, yes, there was a period of relative or underperformance for trend following systems, and our analysis leads that to be due to zero interest rate policies, quantitative easing, and the suppression of volatility. Now, is that a bad thing? We like to think of markets as accumulating and dispersing energy. So if you suppress volatility for a decade, well, guess what? The next decade is probably going to be absolutely fantastic, and it has been. Right, so there is no way to get rid of this risk. You can contain it, you can control it, you can try to suppress it, but eventually the markets will need to find an equilibrium. So I would say that lost decade is an anomaly. I think if you do look at 50 or 60 year track records and back tests, you'll note that that period is not necessarily reflective of the greater outlook for trend, and I would say that we've definitely moved into a different type of regime. I think there's a number of, fiscal and monetary factors, inflation, and other geopolitical, sort of events and scenarios that are very constructive for trend following for the future.
I mean, was it a lost decade? I think it was a underperforming decade. The last time I heard the term lost decade was in the middle of 2008 when stocks had a negative return for 10 years. But I think, that people have done studies on trend following underperformance. AQR was one, and there were some other ones. And it's basically, the conclusion is usually the same, and that's just a lack of trends for whatever reason. I don't think it's helpful to focus too much on fundamentals, and I don't think it's helpful to say, that's an excuse, because look, maybe we shouldn't be trend following. You have my money. You told me you're going to make money with it. I'm not letting you off the hook just because you didn't have big trends. You chose a system that it relies upon big trends, and so they're infrequent. And now they've become really infrequent. So we have to just suck it up and take our medicine. And but this is a strategy that is totally dependent upon the huge trends. And when we get them, we feel really good, and we say, that's just the greatest thing ever. No system on the planet can make up for missing cocoa. If you miss cocoa, you don't have a system that can make up for that dumb move of kicking it out of your portfolio. So keep it in your portfolio. Don't kick things out of your portfolio. It doesn't matter how they performed historically. You have it in there because it's diversifying. But we don't want it to be too diversifying. I don't want to pay attention to correlation and too much diversification or split things up 50%, split the risk in two, because we don't care about smoothness. We don't care about the diversification enough. We care about it a little or a lot, but what we really, really care about is if you're trading a lot of different markets and hitting these outliers. And once again, we will trade two markets that are 99% correlated, almost all, that are highly correlated almost all the time, just in the hopes that one of them might have an outlier and the other one doesn't. So I don't want to cut them in two. Brit could have a huge move and WTI may not have a move. And now I've cut Brit in two when my whole purpose of existence was the outlier and not having a smooth portfolio. I mean, with 400 markets or 100 markets, commodities, currencies, stocks, and bonds, you can't help but have some smoothness and some diversification, even if you're not trying, and even if your primary goal is to find outliers, even in unlikely places.
All right. Well, the final question is from Wayne Jarvis, and Wayne asks, I hear often that fat-tailed events happen more frequently than models assume, but how do you quantify that? I've heard you mention that positive outliers occur 5 to 10% of the time, but 5% of what and over what period? So, look, I do have something to say here. So I might start first, and then I'll pass it on to Jerry and Adam. What I'm referring to here, I've talked about it earlier in this episode, is the scale invariant nature of fractal systems. So what you find is that if I took a small sample over a fractal system, I would find that in that sample, there'd be 5 to 10% of that sample which dominate the structure of that sample. If I then get a larger sample, I'll still find that, relatively speaking, 5 to 10% of those dominant structures. So it's this scale invariance that's important, and just how I measure it. So I don't use a Z-score to measure my outliers in my distribution. When we find outliers occurring in our distribution, we find that the mean and the standard deviations are themselves influenced by outliers, and these extreme values, they distort the actual results, making Z-scores sort of inappropriate. They're appropriate to use for Gaussian systems, but when you are looking at what fraction of the trades are outliers in your distribution, I'd be saying use a modified Z-score. And what you do there is you're using what we call the median absolute deviation to determine what is classified as an outlier. And so the way I measure it is anything that is greater than 3.5, which is the absolute value of the MAD value, is what I call an outlier in my distribution. And when I look at that distribution number, I find that about 5 to 10% of that distribution comprise these outliers, no matter what scale I use. So if I have a small portfolio, when I do that, 5 to 10%. When I have a large portfolio, when I do that, 5 to 10%. We find it's this scale invariant system, nature of this system occurs in the financial markets, and that's why I'm saying that they're fractal systems. That's how I quantify the number of outliers in my distribution.
I think Wayne has asked a good question here, and but I think the word that he's missing is not 5 to 10% of the time; it's 5 to 10% of the trades. So I think that's what he's missing there. I've actually heard people say on podcasts that 5 to 10 trades, which is totally ignoring the fact that some people trade 10 markets and some people trade hundreds of markets and 400 or 500 markets. I'm not the only person who trades 300 or 400 markets. I think Flooring Cart trades 400, maybe 500. And they don't trade, and half of my markets are stocks, which is kind of cheating. They don't trade individual stocks, I don't think. So it really is just a question of what's your portfolio. You know, you want to have this fixed portfolio, and so keep it constant and doing the trades, doing all these trades in the same markets and suffering and not having an outlier show up like in cocoa. Then all of a sudden, cocoa is still there, it's still one of your markets, and you finally get that outlier. So it's, I think, roughly 5 to 10% of the trades, and that could vary over time. It could be zero sometimes. It's another good reason of trading so many markets is the bad luck factor of this 5 to 10% will be smoothed out over time. Where if you only traded 20 or 30 markets or 50 or 60 markets, you know, you could have way more than 5 to 10% and 0% sometimes too. So that's something to try to be avoided.
I think you've both covered that question pretty well. The only thing that I would add is that the way I do this is basically creating a histogram of the trades, which has the frequency and the profit or loss, and you can just visually see the outliers on that histogram, and you will be able to basically differentiate between quote unquote average trades, and then where there's a loss, a small loss or a small gain, and then these outlier trades, which yes, they're 5 to 10% of those trades in aggregate, and you will see them on that histogram. And the goal is to not filter yourself out of those trades. So the more markets, the better, the looser the pants, and you've got to be aware that there's clustering in those returns. So it may well be that a lot of those outliers come at once, and then you might have a period of time where there are no outliers. So small bet sizes and controlling aggregate risk through that small bet size, I think, is key.
That's it for the questions for the month. Now, don't forget, listeners, to send them in by going to our contact page on the Aussie Turtles website. You can either record your question or write your question in the comments section on that field. So, it's time to wrap up this episode. So, Jerry, are there any closing thoughts on this episode for you?
Oh, no. I'm not prepared for more closing thoughts. I gave it all I had during the regular time there. So, but it was good to be back with you guys, and it's always fun. And I'm still looking for my missing wine. If you know what I mean.
Well, yes, we enjoyed it. Adam and I did.
We had a fun time, right? Did. I think next year it's going to be we're going to be recording from Vegas or something. What do you think?
Oh,
is that a good
sounds
idea?
Good. Yeah,
I like that. Sounds fantastic.
All right, you're on. All right, Adam, any final thoughts for this episode?
Oh, look, I would just say backtest. It's fun looking at charts and watching the silver market close above $45, but I think the value is in the backtests and the stats and the trade levels that delivers.
Yeah.
So back to you, Rich.
That's great. Many thanks, guys. Well, that's it for episode 7 of Turtle Talk. Thanks for joining us, everyone. We'll be back with more charts, conversation, and trend talk in the next one. And before we go, I just want to mention that our first book, the Aussie Turtles Trend Following Guide, will be launched, I think, next week on Amazon in a Kindle and paperback version to start. We'll get a hard copy a bit later happening, but we're looking forward to that being released. And Jerry was kind enough to give us a great foreword in that book. So many thanks, Jerry, for that. Without more ado, it's time to say goodbye, and we'll see you next month. So until then, stay systematic, stay patient, and may the trend be with you.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time, and as always, may the trend be with you.